what does it look like on the balance sheet? So here's what actually happens in an FX swap. So number one, you give someone yen, and we're going to use the Japanese example. So number one, you give someone yen. Two, they give you dollars. Three, you agree to reverse this transaction later at a set, predetermined exchange rate. It is that simple. Think of it as a loan. But the key is the FX forward price, because that price contains a funding spread. It tells you how expensive it is for the rest of the world to get dollars today. So when the FX swap basis gets more negative, and again, we will do a extremely detailed episode on the when we start getting into the really minute details of this stuff. I'll break it down in more depth. But so when that swap basis gets more negative, it means dollar funding is tight offshore. Global entities are desperate for dollars. Eurodollar markets are stressed. Swap line demand increases as well. So this is the pulse, you can say, of the global dollar shortage. So why do FX swaps matter more than LIBOR or SOFR? I think this is an important point. FX swaps are the largest source of synthetic dollar funding in the world. This means that foreign banks can borrow dollars without U.S. banks lifting a finger. This being entirely outside U.S. regulation as well, using their own currency as collateral, and through global dealers. So the global dollar system is much bigger than the domestic U.S. dollar system. So when Japanese banks, European banks, Korean banks, even Middle Eastern banks need dollars, they go to the FX swap market first. This is why BIS researchers call FX swaps the missing dollar debt. It's enormous and invisible on traditional balance sheets. So probably the next best thing to transition to would be to ask the question, well, who provides the dollars in FX swaps? And I don't hear a lot of explanations on this, but in an FX swap, the dollars typically come from U.S. money market funds, global dealers, U.S. investment banks, sovereign wealth funds, who else? Multinational corporations hedging flows. That's another one. These institutions lend dollars into the swap in exchange for a future return determined by that forward exchange rate. So this creates a global funding loop. U.S. dollar investors lend to foreign banks through FX swaps, even if those banks have no U.S. presence. And this is how the world works in practice. So let me repeat that one more time, okay? Because this is a really important part. These FX swaps are coming from U.S. money market funds, global dealers, FX dealers, U.S. investment banks, sovereign wealth funds, and multinational corporations that are trying to hedge flows. So these institutions are lending dollars into the swap, and in exchange for doing so, there is a future return, which is embedded in by the in that forward exchange rate. So, and again, this creates that loop over and over again. So, let's talk about swaps as a shadow repo market. I would say FX swaps and repo are more like cousins. Both are collateralized, short term, rolled constantly, used for funding, very sensitive to volatility, dominated by dealers. That's a fact, and central to global liquidity. So repo collateral is treasury, and FX swap collateral is foreign currency. So this means that FX swaps are the repo market of the global dollar system. They're the single biggest way the world becomes, or the world borrows dollars without directly touching the Fed or U.S. banks. So maybe an example of real time global dollar shortages. So like during global stress, 08, 11, 15, 20, 22, the FX basis blew out. This means dollar funding became extremely expensive offshore. Foreign banks also scrambled for dollars, and cross-border liquidity really evaporated. It is the offshore version, call it, of a market-wide bank run. I would put it. But instead of depositors running, its institutions are running for dollar liquidity. So this is why market sell-offs often begin in Asia or Europe before the U.S. Even opens. The FX swap market is signaling distress hours before New York wakes up. Let's talk about the Fed's swap lines. So when the FX basis explodes, offshore banks can't get dollars. So who steps in? What happens? The Fed opens up swap lines with foreign central banks. So how that works is that the Fed lends dollars to foreign central banks. Foreign central banks lend those dollars to their banks. Those banks meet dollar obligations offshore. So the FX basis starts to normalize. And then consequently, global liquidity starts to stabilize. So this is why the Fed rarely lets the FX swap market break. So in 2008 and 2020, swap lines were the real bailout, not QE. So swap lines stabilize the global dollar system, not the domestic one. This is the moment where the Fed becomes the central bank for the world's funding markets. And this understanding brings, in my opinion, I think some ease of the mind, because you can understand all these things that are happening. And I like to reiterate the fear behind uncertainty and crises. So in this one tool explains emerging market crashes. It explains the 2008 contagion. Dollar weaponization debates. So this is a really important tool. And FX swaps really are the hidden skeleton, I would say, of global dollar liquidity. Well, that's the end of the episode. I really appreciate you being here and listening to episode 14 of the Global Ledger. We talked about a really important tool. That was the FX swap market. And it showed how it silently stabilizes or destabilizes the entire global dollar system. So in episode 15, we continue building the global architecture. Collateral is probably the next seemingly important topic to talk about. Collateral being the real anchor of modern finance. I'm Justin, and thanks for being here.